Dividend investors love a good ETF, but with so many choices out there, how do you know exactly which one is right for you? Today, we're putting three of the most popular ETFs in a head-to-head comparison, which is the SCHD, the VYM, and the SPYD. They all sound very familiar, but trust me, there's a difference that can really make or break your portfolio. In this video, we're going to be breaking down all three of these ETFs with a side-by-side comparison. We'll look at their dividend yield, the performance history, expense ratio, and the risk profile that are made up with these companies. By the end, you'll know which ETF can best fit your strategy. Whether you're chasing income, long-term investing, or looking for that growth, stick around because the analysis might change the way that you see these ETFs. Now, if you caught yesterday's video, we did drop the SCHD. We dropped all of our dividend yield ETFs. A lot of people were on board saying that was a really smart idea, focusing on growth for the next 20 to 30 years. A lot of people said it was a horrible idea dropping that SWAB US dividend equity ETF, but over time, we will see the results. And honestly, either way, it's really up to you and your investment strategy, what your portfolio looks like, and if you're chasing that dividend yield, if you're focused a lot more growth, or if you have a balance really between all of those within that portfolio. So let's hop over and check out our side-by-side comparison of three of these ETFs. So right here, we do have the SCHD, the VYM, and the SPYD. Now, the reason why I did choose all three of these specifically is there were a lot of people and a lot of comments about the dividend yield ETFs that people were sold out or getting rid of the SCHD. They were moving all of the funds to the VYM. Even a lot of you said the SPYD was a lot better than the SCHD. So that is why I wanted to do the video tonight that really focuses on all three of these kind of in a side-by-side comparison so you can see them on an equal kind of footing. Now, looking in here, and I want to break it down because the holdings make a big difference. Now, the SCHD at 101, the VYM has 582 companies. That is a lot of companies for a high dividend yield. And as we can see from the SPYD, there are only 82 companies. So again, right off the bat, it seems like the SCHD and the SPYD are a lot similar with the amount of companies they're holding and really differentiating. We'll see in just a minute. Looking at the performance in here, you can't really look at this because the SCHD did have the stock split, so it did change. But looking at the performance, it's a lot closer than you think. The SCHD 2.46, 2.26 with the VYM, 2.48 with the SPYD. So not a lot of change within there, but I like looking at a bigger time frame. When we start thinking about an investing time frame, we are looking at 5+ years. And that is, again, where you can really see some of this kind of change and some of this kind of branch out, and also looking at the dividend yield. Now, looking at the SCHD, on the 5-year, we are at 11.71 right there. The VYM comes in 14.8, so definitely a little bit of a stronger growth. And then even looking at the SPYD, 14.45. So all of them are eclipsing the SCHD in a significant amount when it comes to growth. But I do not believe this brings in the dividend yield that is equated in there to get the total return. You have to know that it is a little bit different when you start looking bigger picture, because even looking at the breakup of the VYM to have all of these companies, I mean, 10, 13, 12, and 14% return over the last, going from 3 months to 5 years is a pretty good return. Now, also remember the SCHD does go through that reconstitution every single year. And I feel like personally, the last few years is where we've seen a lot of this drop in the 1 year, even the 3 year, in comparison to some of these ETFs is really the foundation or the fundamentals that they did have in here. Now, expense ratio, they're almost exactly identical, so not really a big change there. The big thing that I noticed is the holdings. So if you look in here, even looking at the SCHD, Chevron 4.32, it's not even in the top 10 of any of these other companies. Altria, which we know is a very high driven yield. Again, when you start looking at the comparison with Chevron's way down there, they do have some overlap, even looking right here, Altria and Altria. Some of them do have a much different percentage where the SCHD is holding 4%, the SPYD is only holding 1.4%. So again, that makes up a really big difference on the companies that we're focusing on. And the VYM also is very heavy when it comes to JP Morgan Chase, and a couple of the banks themselves are really big in here. We can see Bank of America in here. We can see JP Morgan Chase. they are really big in the financial sector, which we'll look at in just a minute. That is kind of where it's interesting to see that the VYM even does hold so many different stocks in the portfolio, yet they're at a much smaller percentage. When you start looking at the very bottom, it is almost non-existent to what they're holding within these companies. Then we get into the sector. Now, this is always very important depending on what you're looking at, because there is a lot of overlap. Again, the SCHD, very similar to SPYD. And then the VYM is a different build because you can see right in here, when it comes to technology, the VYM has 16% in technology. The SPYD has none in here at all. This little sector has nothing in it. And then when we look at finances, like I said earlier, SPYD has 37% into the financial sector. That is huge, where the SCHD has less than 10%, but you can see some of them do have a really big lap in the consumer non-durables. Also health technology. This is again where when the reconstitution happened this year, a lot of the SCHD went into these consumer non-durables, also went into this health technology. That is where we've seen a majority of this portfolio, which again, that reconstitution that we seen back in March, I feel like it really hurt the SCHD overall to keep that dividend yield a little bit higher. Then when we look at the actual breakdown, you can see that we have 16 plus the 14. I'm in earth minerals right here. Even electronic technology, 12%, but healthcare, all three of these sectors together, you're talking almost 50% of the portfolio in its entirety is in those three sectors itself. So that is a big chunk that is in one specific sector. So if you're looking for diversification, not worth it. But honestly, these are more driven by the ability to generate income versus being diversification. But when you start looking at some of like the VOO, the QQQM, I'm not going to be as well versed in the technology sector, which again, by design, they are not growth ETFs. Now, looking at the VYM, you can see kind of the same thing. We have some like the financial sector, 22%. That is a massive part in this financial sector. Even when we look at these couple, like 4 or 5, you can see that makes what, 10, 20, 30, 40, 50, almost 60% of the portfolio is in those 5 different sectors. SPY, again, looks here at 15% in the consumer non-durables, which is very similar again to the SCHD. Technology, not even in there. So again, there are nothing and there is nothing in technology, and a couple other breakdowns. But then we look at, of course, the biggest thing here, which is the distribution yield. This is what people look at: SCHD 3.8, VYM 2.6. So even though we're seeing that growth factor with the VYM, distribution yield is incredibly low in comparison to a high dividend yield ETF that we see. Then we have the SPYD dividend or distribution yield, 4.5%. That is a pretty solid yield in there, and it has some pretty solid growth behind there. So again, depending on what exactly your portfolio looks like and what you're looking for, it does make a big difference. Then we hop over to the total returns. All charts below are with dividends reinvested. This is where, again, it gets a little bit interesting, because when we start looking at some of the breakdown and even looking the year-to-date return, 9.82, SCHD 3.57, SPYD 6.44, and that's as of 8/22/25. So we are right on target for where we are. Now, looking at the returns, you can see overall SCHD has been outperforming. They are actually this top blue trend line that we're seeing, and honestly, a lot more that we see here with the trend line going on with the SCHD. Even looking at the VYM and the SPYD, you can see they are lagging a considerable amount. And of course, we've seen when COVID happened, we've seen a massive drop right here. But you can see they were kind of on par, running a lot of the same. Then right here, boom, coming out of COVID, SCHD just absolutely took off. Even looking here, it seems like a little bit of a much further drop, which I believe here was like a 30 to 40% drop. Which we've seen a lot of the funds take right there. And you can see, though, the SCHD doing incredibly well. Then when we come down, overall returns, this, of course, looking at the time frame 10/22 of 2015. So we are looking at roughly the last 10 years. The VYM overall return 179, SPYD 133. So again, pretty far below the average. The SCHD 197 right there, which is breaking out and really well above the VYM, well above the SPYD. And again, this means that the SCHD has been performing over the last decade much better than the VYM. So people who are taking money and putting it into, or taking it out of the SCHD, putting into the VYM, it's very interesting to see the overall return over the last decade. Then, of course, we get into the starting value. It's going to show the exact same thing. Right here, we'd have 29,000, 27,900. So it really does make a big difference when we start looking at the last couple years and the returns itself. We have seen a couple in this again. This is just me thinking out loud, thinking about the returns that we see. Even in 2022, we've seen a big pullback in the market, not as affected in the VYM, 3% down in the SCHD, 1% in the SPYD, but you can start looking at some of these negative return years where it really hasn't outperformed. But I want to look just at these last couple years. So looking kind of at the 2025 and looking at these last few years and seeing where they're at, is you can notice that there almost has been somewhat of a shift with the SCHD within the last 3 years with the reconstitution. Most of the other funds are outperforming on the annual returns. That is where I feel like even looking here, 2023, the VYM outperformed. The VYM in 24 outperformed. So far, they're outperforming this year. And then, of course, even looking at the SPYD, almost on par there. They outperformed in 2024, outperformed the SCHD in really 2025, which again, me kind of thinking about it, it seems like the SCHD had and does have a super, super strong, solid track record over the last 10 years. For the last 2 or 3 years, it seems like it's really fumbled when it came to that reconstitution and exactly the methodology that they have in here. And I don't know if it's because, the really big takeoff of all of the tech stocks, but overall, the SPYD doesn't have very much in tech, still outperforming when it comes to this annual return, even though, the SCHD has a very solid dividend. So depending on what you're looking for, it seems like, again, the VYM, definitely a little bit less when it comes to what they're offering or what we're receiving for that dividend yield. So as a growth fund, I feel like it does have a little bit more growth, a little bit less in that income generation. SCHD seems to be a pretty decent blend between both of those. And again, looking back, guys, when you look at outperformed, I mean, really outperformed, even these last couple of years, outperformed right on par. Definitely, it seemed like the SCHD had its day, and I don't know exactly what's going on. It doesn't mean in the future it's not going to be something that I'm going to hold to supplement my income and income generation. But I feel like as of right now, I've seen the last 4 years, and unfortunately, the writing was kind of on the wall. A lot of articles, a lot of research that have said the SCHD seems to be underperforming in comparison to some of the counterparts where you could get a little bit more growth out of the tech side, but also seeing a little bit more really of the growth was what I was looking for. And I know a lot of you said the VOO, the QQQ, really in comparison to the SCHD is not really fair. And no, for a dividend versus a growth ETF versus really a foundation, a staple with the VOO, it is not really fair in its entirety. But when we start looking at something like the SCHD and holding it in a smaller percentage in portfolio, it is a lot more of a defensive play. It's a lot more, if the market does have a good pullback, we should not see as much or as high of a pullback with the SCHD. But again, you're not going to have those very high highs. You're also not going to have those very low lows when it comes to this ETF, which is kind of the design of it. But like I said, I feel like the reconstitution here did hurt the SCHD a little bit. And unfortunately, it seems to be showing when it comes to the build of this and when it comes to where we've seen it perform in the last 4 years. A little bit disappointing in there. So overall, guys, when it comes to the SCHD, like I said, it can be and is for a lot of people a very staple part of their portfolio. I decided, and again, it was a tough decision holding it for almost the last 4 or 5 years to actually exit out of the SCHD in hopes to get a little bit more growth. If we continue on the track that we are, having a little bit more in that growth is going to give me the ability to grow the portfolio much larger and then moving a certain percentage into that SCHD. I'm not saying by any means that this ETF is wrong. You shouldn't hold it. You should sell it. I'm just sharing with you my personal experience and what I did in my portfolio to get a little bit more growth, knowing there could be a 20, 30, 40-year time frame that we could have a runway of a lot more growth. Now, again, 20 years, and that's kind of the target. at the target age of 65, going through retirement, supplementing income with the SCHD, or even looking at what an ETF looks like in another 20 years is going to be super, super interesting. So, all right, guys, so if you found any value in the video, definitely give it a like. Let me know in the comments what you guys think. Subscribe to the channel. We have a ton more content. We put out videos every single day. Not a crazy amount of editing, not a crazy amount of graphics, but overall, I like getting the exposure and getting the content out there to you guys. So again, guys, if you like it, definitely subscribe to the channel, and I'll catch you in the next video.